My next guest says signals around what comes next are just as important as the policy rate. Sounds like our earlier discussion. Lo Toney is founding managing partner at Plexo Capital and a CNBC contributor. It's good to have you here.
Thanks for having me.
So the Fed, some say, needs to make sure that it doesn't further stoke an AI bubble here. Do you share those concerns?
Well, what's interesting is if we look at the anticipation, it's already been priced in to see a drop of 25 basis points. And as your former guest alluded to, really, I think the story here is not only the drop in the rate itself, but also the balance sheet. And so we're going to have to listen very closely to hear what Chairman Powell says to let us know, now that quantitative tightening has ended, what we're going to do in this maintenance mode for the balance sheet.
Why are you as a VC so obsessed with that, right? Like, why does it matter? Why is it so impactful?
Yeah, it's so impactful because what we've seen now is that the private companies are really driving a lot of what happens in the public markets. And so for an investor, we need to understand all the dynamics that happen within the entire macro, because we have moved from thinking about these typical software company investments as being just huge cash flow machines. They're starting to look in the public markets more like utilities. The having to build out this infrastructure. You know, when you look at a lot of these companies, even Alphabet issuing about $25 billion in debt. Now, we'll have to see how much of that is used for refinancing, but even in the notes, they said this is going to be partially for AI infrastructure. And it's because, as Morgan Stanley has estimated, we likely need about $3 trillion in infrastructure to be built over the next 5 years, and about half of that is going to need to come from the debt markets.
Right, but so some say they don't want the Fed to lower rates and kind of then really open the floodgates to these companies are already able to borrow at pretty good terms, right? And maybe it's not up to the Fed, maybe it's the marketplace telling you what the appropriate borrowing rate should be. Do you think this is all building up towards an AI bubble?
Well, let's think about this in two ways. We're an investor in Anthropic, and I like how Dario approached this at DealBook with your colleague hosting.
Right.
He said that when you look at it, we're not in an AI bubble when it comes to the actual technology itself and the use cases. That's real.
Yes.
But what we do need to get our arms around is this new dynamic that we've entered, where we're requiring massive amounts of infrastructure to be built out. And when you look at a lot of the companies, I look at an Alphabet, which I've written about a lot, being able to really fund a large portion of that through their cash flows. But then we look at some of the other companies like Oracle, like Meta, Oracle just hovering right above junk.
Right.
They are making a massive bet. But what you look at are how the market is reacting, and you can really see it with the credit default swap spreads that look at Oracle and how much those are going up. Oracle announces at the end of the day, so it'll be interesting to see, is that a canary in the coal mine moment about AI infrastructure build out, or is Oracle going to signal that they actually have the revenue?